Hello and welcome to the Crypto Experts. Numerous digital currencies, tokens, and distributed apps exist, each with distinct purposes and features. As the crypto sphere expands, increasing awareness and understanding is incumbent. However, ideas such as blockchain, mining, and staking can be challenging to grasp and even more difficult to describe in straightforward language. This presents a barrier to widespread crypto acceptance. Luckily for you, this video introduces crypto ideas in a manner that's easy enough for a fifth grader to comprehend. If you like what you see, don't forget to like this video, click the subscribe button, and hit that bell to get notified of new videos. Cryptocurrencies are similar to traditional currencies but exist solely in the digital realm. At its core, each cryptocurrency coin is essentially a combination of alphanumeric characters. While this may seem complex, it's not too different from how modern currencies function. Every physical banknote has a unique serial number, revealing details such as printing date and location. If you use a credit or debit card, you would know it has an account number and needs a password or PIN to access the money. When you open the account, you provided personal information to the bank so they know your account number and name. Both the central bank and the government also receive this information. For instance, you have a $100 bill with a serial number XTZ and your bank account number is 666. If you deposit this bill into your account, the bank branch, central bank, and government will check and confirm that the $100 bill with serial number XTZ has been transferred to the bank account number 666. This process is similar to how cryptocurrencies operate, where each coin is like the serial number of a physical banknote but doesn't have a tangible form. Like traditional banknotes, cryptocurrencies can also be divided into smaller units. For example, one Bitcoin can be split into 100 million parts known as satoshis, similar to dollar cents. In the case of cryptocurrencies, a wallet address works like a bank account number, but no physical card is attached to it. It's just a means to receive and send cryptocurrency transactions. Unlike traditional bank accounts, setting up a cryptocurrency wallet does not require personal information, so your identity remains anonymous. Any cryptocurrency held in your wallet is directly owned by you instead of being managed by a bank. As a result, no one can restrict your transactions or shut down your wallet since you have complete control over the account. If you lose access to your cryptocurrency wallet or forget to record the recovery phrase, your cryptocurrency cannot be recovered. Unlike banks and governments monitoring individual banknotes and account balances, cryptocurrency information is dispersed among computers in the cryptocurrency network. The transaction history and account balances are publicly accessible records that anyone can view through a blockchain explorer tool. The process of earning cryptocurrency for processing transactions on a cryptocurrency network motivates more computers to join and increase network security as there is no single point of failure. This is known as decentralization, which is the opposite of the centralized setups of governments and banks. Therefore, the payment networks created by banks worldwide are not considered cryptocurrencies but a bleak of dystopian form of payment. When it comes to Bitcoin, Etherium, and other commonly known cryptocurrencies, understand that there are thousands of different types out there, just like there are many different regular currencies. But each cryptocurrency is distinct and not all are intended to be used as a currency for daily transactions. Most of the time, coins and tokens make up the world of cryptocurrencies. Cryptocurrency coins are part of cryptocurrency networks created from scratch, meaning that someone has invested significant time and resources to develop the complex coding necessary for a secure and dependable cryptocurrency network. When computers process transactions for a cryptocurrency network, they receive cryptocurrency coins as a reward. For example, BTC is a cryptocurrency coin because it is given to computers that process transactions for the Bitcoin network, which was built entirely from scratch. Due to the complexity of creating cryptocurrency networks, only a few coins exist, with the remainder considered tokens. Unlike coins, creating tokens is relatively effortless and can be done in a matter of minutes, which is why tens of thousands exist. The increasingly popular NFTs that people keep mentioning are in fact cryptocurrency tokens that act as digital certificates of ownership for physical or digital artwork. NFTs are just one example of how tokens can be used, as numerous other possibilities exist. Remember that many cryptocurrency tokens are scams because they are so effortless to create. Scammers can quickly generate a token, create an attractive website, and pay for advertisements on social media and news outlets to promote their cryptocurrency. By doing so, they can easily lure crypto beginners and make a significant profit without lifting a finger. The safety of a cryptocurrency ultimately depends on the circumstances surrounding it. Certain cryptocurrencies prioritize speed over security, and this trade-off often has immediate consequences. Fortunately, hackers are constantly attempting to break into cryptocurrency networks and manipulate them, creating new coins and tokens out of nothing, which they can sell to make their pockets fatter. While it might seem concerning, the reality is that cryptocurrencies are no different from banks and corporations that routinely come under attack from hackers. In response, they tend to strengthen their cybersecurity measures. Cryptocurrencies have been subjected for similar attacks for years, resulting in the development of robust security systems. Certain cryptocurrency networks consist of computers spread worldwide, continuously cross-checking transaction histories and account balances. To corrupt a cryptocurrency network, an attacker must hack more than half of the computers connected to the network simultaneously, which is practically impossible for a network like Bitcoin with millions of computers globally. However, certain cryptocurrency networks have fewer computers processing transactions, increasing vulnerability to attacks. The same principle applies to centralized cryptocurrency services like cryptocurrency exchanges, where most crypto hacks have occurred. These exchanges are much simpler to exploit and in turn more profitable than individual cryptocurrency wallets, which are highly secure. It's better to store your crypto in a personal wallet whenever feasible and use centralized exchanges only for trading or cashing out. Hardware wallets are the best option for self-custody. Regarding criminal activities, it is true that hackers often demand cryptocurrency as a form of ransom. Although Bitcoin is preferred, hackers often exchange it for a privacy-focused cryptocurrency like Monero in no time. Bitcoin and many other cryptocurrencies have transparent transactions and wallet balances, which makes it easier for authorities to track Bitcoin transactions even more accurately than regular currencies. As a result, criminals prefer not to use and store Bitcoin or other easy traceable currencies. Instead, they opt for digital currencies such as Monero, which provides complete anonymity and utilizes encryption that even the US government cannot break, which is quite an impressive achievement. Only a handful of digital currencies are criminal-friendly. The primary risk lies in investing. These digital currencies are highly volatile and their value can fluctuate greatly within a day. Utilizing leverage trading or borrowing money to make trades can compound this risk. Investing in what you're comfortable losing is vital to minimize the risk. Fiat currency was once backed by gold, but that has since changed and all government-issued currencies worldwide have witnessed a value decline. The explanation of this depreciation is that the only thing that supports dollars and euros is the trust individuals have in the governments issuing these currencies, which has been declining over the years. Governments have deliberately printed and manipulated their currencies to serve their interests and benefit corporations that support them while ignoring your needs. Inflation has driven excessive spending instead of saving, contributing to environmental disasters. Cryptocurrencies derive value from their utility, which varies by type. Bitcoin's value comes from its BTC coin, akin to gold in its economic profile. Its supply is limited, with a small amount produced daily, halving every 4 years. If the demand for Bitcoin stays constant, its value will double every 4 years. The demand for Bitcoin has significantly increased due to the eventualities of traditional currencies' inadequacies, which the pandemic has further reinforced. As dictated by fundamental economic principles, prices will inevitably rise when there is a limited supply of something, but the demand for it continues to grow. Several investors perceive Bitcoin as a secure investment to store their capital outside the financial world. The prices of most cryptocurrencies are directly linked with Bitcoin, demonstrating a high correlation between them. However, Ethereum's unique value lies in its practical applications. Its network supports the creation of tokens and decentralized platforms that resist censorship. To initiate transactions involving the creation, movement, and interaction with tokens or applications, Ether is necessary to cover gas fees. The increased usage of the Ethereum network also leads to increased demand for Ether. Ethereum's adoption rate has been considerably high. The value of digital currencies, including BTC and ETH, fluctuates each day because their actual worth remains unknown. This uncertainty also exists in the stock market, gold prices, and traditional currencies, leading to daily value fluctuations. Cryptocurrencies' inherent instability stems from their ability to enable lending, saving, and borrowing without formal financial requirements like identification, credit scores, or banks. They allow for direct transactions without intermediaries, which could lead to community-based funds, potentially removing the need for governments. This revolutionary concept contributes to crypto's volatility. Some may compare cryptocurrencies to a powerful alien technology, threatening the status quo. Due to this potential, cryptocurrency investors tend to be highly emotional. Even the slightest possibility of restrictions on cryptocurrencies can cause a market crash, while the most unrealistic rumor can significantly surge prices. However, the cryptocurrency industry will continue to expand in the long term, and the growth is expected to remain uninterrupted for the foreseeable future. When deciding which cryptocurrencies to invest in, consider your timeline and level of risk tolerance. The cryptocurrency market appears to observe a 4-year cycle, which means the market is now in the bull phase, with prices gradually increasing. While most cryptocurrencies have already seen significant gains during this phase, a return on investment of 2 to 3 times is still possible. It is even more probable if you decide to hold on to your investment until the next bull market. The profit margin of buying and holding cryptocurrency is equivalent to actively trading in the crypto market. The concept of risk tolerance might seem amusing when it comes to cryptocurrency investments, as they are usually considered risky investments. However, there are varying degrees of risk within the crypto market. Naturally, the greater the risk an investor will take, the higher the potential reward. Evaluating a cryptocurrency's market cap is the simplest method of assessing risk and reward. This metric is crucial to consider as the dollar value of cryptocurrencies can be deceptive. A cryptocurrency's market cap is calculated by its circulating supply multiplied by its current value. Generally speaking, a cryptocurrency with a smaller market cap has a higher potential for growth despite its actual dollar value. This is because less money is required to increase its value. The majority of the digital currencies that are in the top 10 regarding market cap can be viewed as low-risk investment. Cryptocurrencies like Bitcoin, Ethereum, and Cardano will persist for several years. They are likely to experience a doubling or tripling of their value, but no one knows when that is. The remaining 90 cryptocurrencies in the top 100 can witness gains of 3 to 5 times their original value. However, the lower a digital currency ranks on that list, the riskier the investment becomes. This is because it takes less money to cause fluctuations in price. It is recommended to avoid investing in any cryptocurrency that does not feature among the top 200 in terms of market cap. Most excellent projects have emerged, and venturing further down the list is a gamble. This was the Crypto Expert with cryptocurrencies for newbies. What do you think about the crypto market? Comment your thoughts below. Until the next video,